Hello and welcome to this market special from Business Today. I'm Udayan Mukherjee, and today, for a change on the show, we're going to talk about the market's technicals. And to talk about that, a technical veteran of the market, Atul Suri of Marathon Trends, has joined me. Atul, good to speak to you after a long time. But it must be a confusing time, even technically for you,
Nice to be.
because just last week we were talking about 18,000 Nifty and the possibility of new highs against the run of play, and there has been a very sharp 1,000 point setback. How do you feel about the market now? Do you think new highs are uh, possible anytime soon, or is a retest of the June lows a greater possibility?
So if I look at markets, it's difficult to look at it just as secular as India. I think you have to look at the global scene because we know that the bigger movements that are happening are global. The positive is that obviously India is doing better than most global markets. But when I look at global markets, I look at something called the All Country World Index. This is a summation of around 49 global markets. And what is visible is that there is a correction across the globe. It's almost about 20%. And the interesting part is that we have or are in a correction that's a good time and price wise correction. Time wise, because the last highs were almost a year. So a year has passed since we've revisited the previous top. And second is that if you see the size of correction, we may call it a percentage, but the all country world index has gone below the pre-COVID top. So, in Jan 20, when COVID hit and markets fell off the cliff, in fact, the markets have gone below that. And if you look at a lot of subsets, like especially the European place, they're well below the 2020 top. So there is a lot of damage that has happened price-wise and time-wise. And the silver lining in all this is obviously that the markets are extremely oversold. There's extreme pessimism. And when you go and dig down and do some more work, as I said, that's probably the silver lining because there are dark clouds all over. As I said, we've had a big time correction, we've had a price correction. The news is horrible. There's really no good news at the moment. But in all this, I think one of the big things that we've gone and done historical studies, I can talk about it, that we are at such extreme oversold levels that historically we've seen that in such points of pessimism, deep oversold levels, very often the markets surprise on the upside. So at the moment, as I said, I'm not calling the bottom, but the risk reward is very much in favor of somebody who is not trying to short sell at this level or not surrender his portfolio at this level. Probably hold on to what you have. And if you've got spare money, again, without trying to find the absolute bottom, interesting place to look for opportunities.
I take your point about pessimism, Atul, but 20% is actually a garden variety bear market. I mean, you look at the previous vicious ones. I mean, forget 2008, which was 50% or more, greater than that in many markets. 35% is pretty par for the course for a proper bear market. In that sense, do you think there could be even more price damage before the dust settles on this one?
I think that the price damage may not be immediate. So let me tell you why I'm saying that. I feel that we are due for a leg up. Now, how much that pulls up, that's a different story because we know that bear markets can also have multiple legs. So let me tell you why I am not so bearish in the immediate short run, in spite of all the negative news. I mean, you couldn't have it worse than Credit Suisse news on Saturday and kept many market participants very active over the weekend. The reason is that we know there is something called, for someone who looks at technicals and charts, there's something called a 50-day moving average. It's a very good intermediate trend study. And when you look at the S&P 500, I call S&P 500 the mothership because it's the top 500 large caps in the US and some of the biggest names in the world. You'll find that the number of stocks above the 50-day moving average is about 3%. When we go back and look at the last 15 years, Udayan, you'll find that these low levels are last seen only 3 times. Once in 2008, second in as recent as 2020, and once in 2010. So when you do these kind of things, you are able to ascertain that where are the points of extreme pessimism and optimism. It works the other way around also. When 90% of the stocks tend to have positive readings. So what we are seeing is extreme negative readings in terms of, as I said, this market is extremely oversold. I mean, it's just waiting for some positive news. Yes, is it going to be the final fall? That only time will tell, because there are too many things at play. There's commodities, there's currencies, there is bond yields. So the play and the problems are plenty. There's a recession one day, inflation the other day. So one is not calling the absolute bottom, but I feel at this point in time, I think it's not a time to be extremely bearish, but rather look at it opportunistically. And on this, you overlay the relative outperformance of India. So I feel that that is again a very, very interesting scenario that is happening out. I know historically you have pulled out the numbers. Historically, we know we can't dealing for very long. But I feel that we are reaching that point of a certain amount of capitulation, a certain amount of extreme pessimism point. And in the past, as I said, historically, we have seen that these tend to be points where the market actually surprises you on the upside. So the attraction is not about finding an absolute bottom, but the attraction right now is the risk-reward ratio.
Fair enough. And we'll talk a lot about the dollar index and the S&P 500 in a minute, Atul. But I just want your thoughts on the Nifty quickly, because that's very widely tracked and of great interest to our viewers. Do you think the market will find a temporary bottom around just below 17,000, or do you think a fall to 16,000 or sub 16,000 levels is likely this year?
I think we would find a bottom pretty soon. As I said, that this bottom is not going to be linked. This whole delinking theory is good in the short term. You may have some relatively good days and bad days, but over a long period of time, you will find that when you overlay markets, you will find that 2020 nobody was spared, 2008 nobody was spared. So when the bigger moves happen, nothing gets spared. It's just the quantum that goes. So even I think that the Nifty is not going to itself make a bottom. It's a secular bottom, not really. It will pretty much coincide with global markets. And so this whole, I feel that, as I said, I don't know the exact timing, I don't know the date, but I do feel that we are at points of extreme pessimism, extreme oversold. And if global markets bounce back from here, I feel Nifty will bounce back pretty sharply. And what's very interesting is that the distance, one is of course the level of 18,600, which was the earlier high, which obviously is a beautiful line, it's all well known. But if you look at the fall that has happened since the market topped in September of last year, you'll find that there's almost a vertical channel. And, just till a few weeks ago, we went and almost broke out of that level, which was around 18,000 or so. So I think that if we break out of this channel, there is a very good challenge to lifetime highs. So my optimism comes from two areas. One is the extreme oversold nature of global markets. Second is India's relative outperformance. And if the first works out, I feel that India can surprise on the upside. Why I feel that India will surprise on the upside, and it's not just about a day or 2 days. We do something called ratio charts. Ratio charts are just comparison between two big indexes. So, we've done some ratio chart work, just as I shared earlier about the 50-day moving average. We do ratio charts of the S&P 500 versus the Nifty 50. And we'll find that the Nifty outperformed the S&P 500 from 2003 to 2008. But post 2008, the US markets, especially the S&P 500, has outperformed the Nifty. But what we are seeing in the last month or so is that, if you look at the graph, this is after a decade, the Nifty has started outperforming the S&P 500. So if you draw a horizontal line on the ratio chart, so these are things which don't happen for a week or a day. These are decadal moves. And when such decadal moves happen, they rarely disappoint. So what I am also seeing is that after a decade of relatively underperforming the US, India has still done well, but relatively underperforming. I think the time for India to outperform has come. So, for investors' point of view, last year everyone was rushing to invest in global stocks and invest in the NASDAQ, very popular ETF. But I think the time for investors to look at India as a relative outperformer has come. And as I said, I'm not speaking about a week, a month, I'm speaking for a longer period of time. So, coming back to your question, absolute bottom, nobody knows. But I do feel that if global markets stabilize, India will really surprise on the upside, because we are almost entering a multi-year phase where India will outperform the US markets.
A thing which a lot of people track these days very closely, Atul, is the dollar index, because the dollar has been so strong against most global currencies. Do you see any kind of topping patterns out there? Because that would be a fairly bullish outcome for not just the rupee, but possibly even Indian stocks.
No, I don't see the dollar settling very soon. In fact, it's in a tear, and I feel that there is still more upside. This is going to be a very big overhang on risky assets. I mean, it not just is equities; it gets even the worst for emerging markets, because probably the worst bunch globally is actually the whole EM space. Unfortunately, India is a subset of that, and that to some extent really guides the whole FII selling that there is. So a stronger dollar is definitely not good for risky assets. At the moment, as things stands, no, the dollar seems to be extremely strong, and it is the worry point. As far as bond yields go, another area which is linked to this, the US 10-year, if you look at it, I do feel that it's not going to have that runaway. We saw this move from 50 bips to 3.5, 3.6 or whatever, that there is almost like a 7x kind of move. But I think that area is going to be a little muted, little settled. The lid is on. But as far as the dollar goes, I still think that there's more viciousness in that tail. And that, if you ask me, if the single chart that worries me globally is really the way the dollar index is poised, because that is not, sort of topping out like commodities. A few months ago, commodities were the big issue. But if you look at commodities, they seem to have topped out and they are actually correcting. Bond yields, they seem to be flattish. Dollar is the pain point or the worrisome.
And when you look at the Nifty sectoral charts in the Nifty, what leaps out from those charts for you as the clear outperformers or the ones that you should be backing?
Absolutely. So I think the most interesting part, what makes me most optimistic is really the composition of the sectors moving. What we are seeing are those sectors which have not moved for a decade. The movement that we are seeing in your whole engineering space. The last time we saw this move in infra engineering was 2008. It topped out there, and it's been a decade plus, almost 14 years or 15 years of underperformance. So what we are seeing is that the kind of movement we are seeing in these spaces, your capital goods, your infra engineering related, and here also I'm talking about quality companies, is very, very encouraging. Autos, another area which we find very, very interesting that's playing out. We find the industrial facing banks. So what it seems to me is that, again, it may not sound right, it may be improper, nobody will believe me, but I really feel that the market is setting up for industrial revival kind of scenario. Domestic consumption and all domestic plays really look very good on the charts for me. And I think that, as I tell someone, I'm getting a kind of a deja vu moment of, these sectors, these stocks, I haven't heard them for a decade. The last time I heard about them was the 2003 to 2008 bull market. So this is really the brightest spot as far as Indian markets go. Yes, index is global, it is gloomy, it's grey. But the silver lining, apart from the Nifty, is actually the sector composition. And, I've seen that when these sectors move, it is not a 3-6 month story. These move multi-years. And if that plays out, or what the internals are showing, I do think that this whole thesis of India outperforming even the US markets plays out. And if there's no crisis or disaster that happens there, see, if there's a crisis or disaster, you can't avoid it. But if there's no crisis or disaster, if markets stabilize, a little bit bounce back, India will actually surprise on the upside. And as I said, it's bottom up. It's the composition of industries, the sectors, the market breadth, which is very, very encouraging.
And what do you see on the mid-cap index chart, Atul? I mean, just to put a relative spin on mid-cap versus large caps?
Yeah, absolutely. I mean, again, area, it's very funny, but interesting, I would say. But the last time, we club mid and small cap together. This time, mid and small is behaving very differently. In fact, the area that seems to be really standing out is the mid-cap space. And even in mid-cap, what we call quality mid-cap, which is, of course, a more, is your judgment of what is quality, but you find that that space is doing very, very well, So in the mid-cap space, you're seeing very good breadth. The quality mid-caps, in fact, many are at lifetime highs. Many stocks are at lifetime highs. So, the market is kind of like shaping up. It's very interesting. It's my feeling, or it's my thesis that, we've had quantitative easing, we've had a lot of liquidity in the system. And whenever this liquidity would hit the system, everything would go up, The rising tide raises all boats. But now, as liquidity is tightening globally, I feel that the market is going to be very selective in its rewards. And this selectiveness is going to happen at the country level, globally. As I said, if you look at European charts, they're a disaster. But there are some places like India, or they're pretty interesting. They have this, they do stand out. Even if you look at sectors, you'll find that some sectors in India are pretty nasty. But a lot of sectors are doing well. A case in point was, I was looking at the pharma index over the weekend. At the pharma, nothing is happening, 52-week lows. But interestingly, 2 pharma stocks are touching 52-week or lifetime highs. So what I'm noticing is that the market is getting differentiated. It is not a case of liquidity gushing. It's, as I said, the decade of moving away from ETFs to managed. For a decade or more, it has been passive investing that's done well. ETFs have done well simply because it's a fusion of liquidity and everything goes up. But I think that liquidity is going to be less available, and money is going to be more choosy, is going to be more selective. And that is why I feel that you will have a lot of differentiation. As I said, countries will perform differently, unlike earlier where everything went up together. Industries will perform differently. And even within industry, you will feel stocks. So I think the time for stock selection, the time for active managers to outperform is going to be back in the coming decade. And just passive investing, I feel, may not be as attractive, because at an index level, we are not going to have that gush, that flow, that liquidity, which is going to, create that kind of froth. Indexes, etc., may remain sideways, range bound, up, down. But a lot of stocks, even today, if you see our Indian markets, they are making lifetime highs. A lot of sectors are making lifetime highs. So that is where the active manager will really come in and have a chance to show himself, because the last decade has been a nightmare. It's been so difficult to beat the benchmarks. But I think the time to beat benchmarks is actually coming up.
Before we end, Atul, let me ask you about Rakesh, because, we haven't spoken since his passing away, and you worked with him for so many years and knew him so closely.
Right.
How do you remember the years that you spent by his side?
Yeah, I think that's a very, very valid question. I've known him for many, many years and worked with him, and he's been a mentor to me. So when his passing away, actually, I began to appreciate a lot more about him. When you're there, you're interacting, you have your good days, bad days, etc. And obviously, Rakeshji, we knew was a success, obviously. And, but we all had our opinions, we had our differences. But when he passed away, I just realized what a big footprint the man had left. Nobody's perfect. But the thing is that his achievements were fantastic. From where he came, what he achieved. And I think he achieved it with a lot of grace. In fact, our stock market had got a lot of bad name due to a lot of players earlier. But Rakeshji actually gave this market respectability. And to some extent, he demonstrated how it was able to make money in a clean way and create and make big money. So my appreciation of him actually has really gone up after his passing away. In fact, I've become such a big fan of his, and I'm really beginning to appreciate all the goodness and the wonderfulness and his achievement. And a lot of words, a lot of lines come to me now, in my silent moments. And I said, oh, Bhaiya used to say this, Bhaiya used to say that. And he was so true. So for me, his passing away has been a moment of, my respect for him has gone up many, many fold. And I now think I've been actually so fortunate that I've witnessed or spent time or being mentored by someone of that stature, that caliber and ability. So I'm actually very, very thankful.
Atul, good catching up after a long time. Thank you very much for your time today.
Thanks, Udit.
If you like the video, do like, comment, share and subscribe.